Have you ever stared at your sales figures and just had that nagging feeling that you're not seeing the full story? Well, today, we're going to cut right through all that noise with two key metrics, gross margin and gross margin percentage. Trust me, these aren't just boring accounting terms, they are the absolute bedrock for understanding your business's true profitability. So let's dive in and see how it all works. You know, it's so easy to get hyped about big sales numbers, but here's the thing, they can be really misleading. I mean, you could be selling $1 million worth of stuff and still be losing money if your costs are out of control. And that's exactly why we need to peel back that first layer and look a little deeper. Okay, so let's get right to it and start with gross margin. Think of this as the first, most basic level of your company's profit. It's the raw cash you've got left over immediately after paying for the direct costs of whatever it is you just sold. So what is it exactly? Well, it's the profit you make before you even think about paying for other big stuff like your marketing, the office rent, or your employees' salaries. It's laser focused on just one thing, the gap between your sale price and the direct cost of that item. And the formula? Oh, it's beautifully simple. You just take your total sales revenue, and from that, you subtract your total cost of goods sold, which you'll often see called total COGS. What's left over? That's your gross margin. Simple as that. So, what do you do with that pile of cash? Well, this is the money you use to cover pretty much everything else it takes to run the business. We're talking about your marketing campaigns, the rent for your space, your team's salaries, and the most important part, whatever's left after all that is paid for, that's your final profit. Now, knowing that raw dollar amount is a fantastic start. But if you really want to unlock the true power of this metric, we've got to look at it as a percentage. This is what gives you a much, much clearer picture of your performance. So, why a percentage? Because it puts everything on a level playing field. A 40% margin means the same thing whether you're a tiny local coffee shop or a giant multinational corporation. It lets you track how efficient you are over time and, maybe most importantly, see how you really stack up against the competition. And guess what? The math to get there is just as easy. You take that gross margin number we just figured out, you divide it by your total sales revenue, and then you multiply that by 100 to get the percentage. That is literally it. All right, theory is one thing, but let's make this real. Let's walk through a super quick and easy example so you can see exactly how these formulas work in action. Let's just walk through it. Imagine you sell a product for a nice round number, $100. That's your sales revenue. And let's say the direct cost to actually make or acquire that product, your COGS, is $60. So you do the simple math, $100 in revenue minus those $60 in costs, and that leaves you with a gross margin of $40. Okay, now for the percentage. We take that $40 gross margin and we divide it by the $100 sale price. You multiply by 100 and boom, there it is. Your gross margin percentage is 40%. It's such a clean, simple, and seriously powerful number. So here's the most important part. What does that 40% actually mean? It means that for every single dollar that comes into your business from a sale, you get to keep 40 cents of it to pay for all your other expenses and, hopefully, to keep as profit. So this all leads to the big question, right? Why should you care so much about this one metric? Well, because it's kind of like a financial checkup for the very heart of your business operations. Honestly, your gross margin percentage is a direct report card on your efficiency. A higher margin, that probably means you've got strong pricing or you're just really good at keeping your production costs low. A lower margin, on the other hand, might be a little red flag that your prices are too low or maybe your costs are starting to creep up. Now, what's really cool is that a good margin totally depends on what industry you're in. For example, a software company might have a massive 80% margin because, hey, it costs them basically nothing to sell one more copy of their software. But a retailer who has to deal with physical inventory might have a 30% margin and be absolutely crushing it in their field. It's all about context. Okay, let's wrap all this up and make sure it sticks. I'm going to give you a super simple 3-step process so you can put this knowledge to work right away. So here's all you need to do anytime. 1, start with your total sales number. 2, subtract your direct costs, your COGS, and that'll give you your gross margin in dollars. And 3, do that quick division and multiplication, and you've got your all-important gross margin percentage.
And here they are, one last time, both formulas side by side. Your gross margin is just a simple subtraction, and the gross margin percentage is just a simple division. You put them together and they give you this incredible insight into the core profitability of everything you sell. So now you have the tools. Seriously, calculating these numbers gives you a direct, unfiltered look at your business's financial engine. So the only question left to ask is, what story is your gross margin telling you? Thanks so much for joining me for this explainer.